Hey, this is Brent from TradeGuild.net. It is September 8th, 2008. You have to bear with me, I'm kind of losing my voice here a little bit. But as usual, the government has stepped in again to save the market. And if you guys remember, back in January, February, March, April, we were calling it the plunge protection team. Every time the market was about ready to crack and break down, the Fed would step in, the Federal Reserve, and they would save the day. And it got to the point it was so ridiculous you could call it, and we did call it within 10 minutes of Fed action. Within 10 minutes there'll be Fed action, just because simply technical levels were broken. The market was about ready to go into the toilet. The Fed stepped in. Well, that's what I think is happening again today, with this Fannie Mae Freddie Mac deal, the bailout, government-sponsored bailout, up to $200 billion for the GSEs. So we're looking at a 9-day chart of the Qs right now. I'm just going to back it out so we can see, the extent of this rally that started in 2002, 2003, and this triangular formation, very typical of a top. And then we look at the big red volume that you can see down here, very typical, of distribution into that top sellers. So we got a breakdown, a technical breakdown. This is on 9-day chart. I'll show you a 1-day chart here. So here's the 1-day chart. We get this technical breakdown, and what happens? Not the Fed this time, but the Treasury steps in with up to $200 billion for the GSEs, because they're having trouble raising capital on their own. So what does this mean for the market? It could be a watershed day in a lot of ways. Mortgage rates are going to get cheaper. Mortgages are probably going to get, a little bit easier to get for a lot of people. Some of the banks are probably going to do pretty well with it. But the flip side of the coin is that Fannie Mae, Freddie Mac are core holdings in a lot of institutions. So those Fannie Mae, Freddie Mac, let me pull up one of them. I'll just pull up Freddie right now. Here's Freddie today. Got hit 82.75%. So if you owned Freddie today, you lost your shirt. If you owned Fannie, let's pull up Fannie, FNM, Fannie Mac down almost 90% today. So, if you had 100 grand in this stock yesterday, you got 10 grand left today. That's the bottom line. When you're talking about institutions that are investing a $500 million maybe, or whatever the case may be, this is a major, major, major write-down coming, okay? So financials did rally today. Here's the financials. Here's XLF. XLF, we've been watching this consolidation in the red trend lines, and we've been waiting for either a breakout or a breakdown. We got a breakout today on big volume, of course, because of the Fannie Mae, Freddie Mac deal. This could turn out to be a head fake, but we'll see about that in a minute. Some of the other guys that obviously did well, housing did very well today, up almost 10%, for obvious reasons. Mortgages are going to get a lot easier. Some of the other sectors that were up, finance, let me pull up RKH, we'll use for finance. Finance up 6.5%. Retail was up 4.3%, telecom up 2.4%. Both of those were on the contributors letter that I sent out. Retail stock ideas and stuff that I've been talking about recently, and those have all done very well. So let's take a look at some other charts. So let's go back to the Qs. This is what I'm thinking. I think this is a major top. I think it's a major breakdown. But look at the volume here, how big this volume is. We have on Friday a little hammer day, which is typical of a reversal. And today's lows were not that far off Friday's lows, so you can almost call this a tweezer bottom. More than likely, with this volume, this is going to be a reversal. We'll see an upside move. But one of the themes that we've been talking about was the breakdown of this triangle before this happened, and what would happen after that. And one of the ideas is that we're going to see a rally after this breakdown back up into or close to the triangle. If we look at some of the other major averages like the Dow Jones 30, the Dow Jones, let me show you on a 5-day chart. Let's go with a 3-day chart. This is a bear flag. You have the flagpole day, and then you have the rally that goes counter to the trend, to the prevailing trend, which was down, which is over here. So this is a bear flag. Typically will resolve to the downside. Go back to a 1-day chart. We see the breakdown of the bear flag. It's been kind of hovering around what was former support, has now become resistance over here. It cannot make it through this red line. I think that we're going to see the Dow Jones 30 with the rest of the market. Again, another hammer there on Friday, typical of a reversal. Big volume down here, typical of an upside reversal. Of course, we had a 2.5, almost 2.6% day in the Dow, almost 300 points, so huge day. More than likely, we're going to see a run, I think, close to 12,000 in the Dow, which will put it, pretty close to resistance level again as this flag matures and pulls out a little bit. The SPY, the spiders, which is the ETF for the S&P 500, let's pull them up. Same situation here. They have this 3-day chart. Here you go. There's the bear flag again. Here's the flagpole. Here's the flag. The flag, it's like an upside down flag. So the flag always is counter to the prevailing trend that precedes the consolidation. So here's the downtrend. You get the consolidation, and you expect a move pretty much equal to the prevailing or the previous downtrend, which is right here. But if we look at the 1-day chart again, and we zoom in a little bit closer, we see we have not quite a hammer, but a hammer-like thing. We've got a lot of volume over here, and we've got a 2% day up. So I think the spiders also are going to run a little bit. I think the Qs are going to run, the Dow is going to run, the XLF financials are probably going to run, I'm guessing, at least to 24. They're at 22.68 right now, so 24 would put them, let me pull out a pointer here, 24 would put them somewhere in this level where there's a lot of overhead supply over here. So these are people that are trapped that would be more than willing and more than happy to sell their shares, if prices come anywhere close to where they got in. So that creates resistance, which means as prices move up here, we're going to see a lot more and more supply, which is supply over here, come into the market. When supply comes into the market, unless there's enough demand to absorb that supply, what we typically will see is a reversal and prices will move down. So 24 is the level I'm looking for on XLF. Big volume there again today. This can very well be construed as a false breakout if this happens. If this runs up to 24, turns around, and then breaks down below 22 back into this flag, watch out below. I think you're going to see these July lows over here. These July lows, I think, will probably get taken out, and I think we'll see a new move to the downside. The reason being, even though the market is forward looking and the GSE is getting some protection, the home builders, perhaps we're going to see a bottom in foreclosures and stuff, but there's still a lot of foreclosures on the horizon. There's still a lot of bad things going on. The problem with the Freddie Mac Fannie Mae thing again is they're a core holding in probably just about any major portfolio. So there's going to be a lot of serious write-downs. A lot of write-downs are going to be taken, and every time we've seen in the past a little thread hanging out of a sweater, it doesn't look like a big deal. Somebody pulls on it and the whole thing just comes unraveled. I think this is one of those situations where these write-downs could lead to failures of some of the smaller regional banks. It could lead to financing problems, liquidity problems for some of the bigger banks and some of the broker dealers. So we'll have to see what happens. But right now the market is ecstatic about it, and of course the world market was up previous to that. If we look at the Qs real quick on an intraday chart, you can see we got a big opening gap up, and they sold that gap right off. They basically faded the move. This is amateurs buying. These are people putting in their orders pre-market or in going to work, or they're putting in their orders overnight. They're going to work, and the market maker or the specialist or whoever in each individual stock, the same thing is happening. Basically, they're making these suckers pay up, and then they're fading the move, basically shorting it. They're making money, and then they're going to buy it just back down here. You see something similar to a double bottom, very close to a double bottom. We didn't make new lows down there at 2 p.m. You can see this rounding volume over here, how it kind of has like a half circle, it rounds. This is very productive. It looks like an upside move is coming. If I pull out the pointer again, we see that somewhere in the 43.50 area, and a gap over here. 43.50 will probably get taken out tomorrow, and this thing will probably run. You got 42.80 up to 43.50. You're going to see at least a buck. I think this is going to run at least to 44, which back here on the 1-day chart, and get rid of the pointer and zoom in a little bit. Bring it right back into this triangle. Any failure after that, all bets are off, and I think you are likely to see a waterfall cascade